It's Jay Joseph, your wealth and financial advisor, here to talk about these things called ETFs, which are exchange traded funds. Exchange traded funds has many benefits. Some of them are: one, they're liquid, they trade like stocks. Right. Number two, they're very cost efficient compared to if I wanted to buy an individual stock that may cost a lot of money, I can go buy an exchange traded fund that has that actual stock in it. In addition to that, when these stocks have quarterly earnings, they can jump up or they can gap down. But when exchange traded funds, they're more stable and more consistent. Exchange traded funds, majority of which actually also pay me to hold them through a form of a dividend, and they normally pay out every single quarter. And when we compare an exchange traded fund, having many companies gives you that diversity. And compared to open ended mutual funds, exchange traded funds are more cost efficient, right? That internal expense fee or the internal ratio are lower compared to an open ended mutual fund. So if you're looking for an investment that pays you to hold it, that's low cost, that's actually also diversified, you should consider an exchange traded fund to actually invest into, and you can actually trade them as well. Until then, keep liking, subscribing, and following for more information from J Money Secrets. Until then, let's invest. It's Jay Joseph with J Money Secrets, your wealth and insurance expert. Now, let me talk to you about the reasons why I like investing in the stock market and why you should be, if not already, invested into the stock market. Number one, the aspect of being able to create income, right? Income can come from dividend paying stocks and or you can trade stocks to create income. Number two, the liquidity aspect. I can actually sell a stock and get access to my money within 2 to 3 days. Number three, diversification, right? Diversification allows me to not be invested into one particular company in or one particular sector. And the stock market actually has 11 different sectors, whether it's from healthcare, technology, consumer staples, etc. All right. Number four, the stock market also gives me an ability to leverage. Yes. And as we know, the number one key to actually building wealth is leverage. All right. Number five, the aspects of being active or in passive investing. The stock market investing in trading can be as passive or active as you want it to be. These are the key reasons why I invest into the stock market, and you should too. Keep following, liking, and subscribing for more tips and information about investing and building wealth so you can leave a legacy. Let's invest. Wealth. One of the main ways to build wealth is we do what? Use this thing called leverage. Wealthy people, we don't save our way to wealth, we leverage our way to wealth. It's Jay Joseph with J Money Secrets, your wealth and your insurance expert. We're going to talk about this thing called options. I want to share something I did with options last week. All right, this is the company called Moderna. A lot of us, we make money when we buy shares and the stock price goes up. That's not only you can make money when the stock price goes up. You can use this thing called leverage. And leverage is the number one way to build wealth. So when using leverage in the stock market, you can use what we call an option. An option is a derivative of underlying security, such as an individual stock or even an exchange traded fund. The individual stock that I actually used was Moderna. So Moderna was a company that I looked at the charts. The chart told me that, hey, there's buyers here. Once I get a certain amount of confirmations, at least 4 or more, I seek to then buy what I call a call. When you buy a call, you anticipate the stock price to go up. As the stock price goes up, my option contracts goes up. And one call option actually controls 100 shares of Moderna. So instead of going to buy Moderna, let's say at $115 a piece, that would have cost me $11,500 to buy 100 shares. Instead, I bought an option contract. As you guys can see on this option contract, I invested almost $1,700. And then I actually made a rate of return of about 121%, which therefore I netted a profit of a little over $2,000 with only using $1,700. Now it's known that the S&P 500 makes a rate of return of about 8 to 10% a year, and I made 121% in a week. This is how we not only just earn money, but this is how we create money. But the key is not only about the money that I made, but what am I actually going to keep? Because we got this thing called taxes that can erode my ability to keep my wealth. In addition to taxes, we also have the opportunity for consumption, buying liabilities, these things that don't put money in my particular pocket. So it's not all about the money I make, but what I keep. And then it's also important, what are you going to do with the money that you keep, and how it's going to continue to work for you, and how long of generations is it going to last? Continue to follow me at Jay's Money Secrets for more tips. We thank you for your time, and until then, let's invest. It's your boy Jay Joseph with J Money Secrets, your wealth and insurance expert. I want to start off by giving homage to the late Kobe Bryant, R.I.P., the great black mamba, one of the GOATs in basketball.
From 96 to 2016, Kobe Bryant made about $323 million in his contracts with the NBA. But in addition to that, Kobe Bryant had investments and he had endorsements, yielding his net worth a little over about $648 million. When he passed in that plane crash, his inheritance, his wife and his kids, they were left behind. And I'm sure he transferred those assets to them. But in addition to having over $600 million in net worth and assets, Kobe Bryant also had a little over $600 million in life insurance policies that he left behind to his inheritance. And those life insurance policies, they pay out tax-free. The question is, what are you going to leave behind for your inheritance in case and when you actually pass? You don't have to be wealthy to have life insurance. You don't have to be poor to have life insurance. I'm going to show you how to use life insurance to actually build, protect, and transfer your actual wealth. Keep following for more gems and tips and information. Connect with me at Jay's Money Secrets on IG, YouTube, and also my website, Jay's Money Secrets. Until then, let's invest. It's your boy Jay Joseph, your wealth and insurance expert. Let's talk about this thing that we hear people talk about called a backdoor Roth IRA. Well, a backdoor Roth IRA is simply an opportunity to give high net worth and high income producing individuals that exceed the thresholds of contributing to a Roth account the opportunity to still contribute to a Roth IRA account. So how do we do it? What does that look like? Well, number one, if you exceed the threshold for individual and or joint making too much income for a Roth IRA contribution normally, what you can still do is make what we call a non-deductible contribution to an IRA account. Now, with this non-deductible contribution, you then convert that over into a Roth IRA account. The sooner you do it, the better. But wait, there's more. Now, when you make that contribution, a lot of times what the IRS is going to do is look at all IRA account assets that you have, and they may give you a pro rata of the amount you have to pay on taxes to convert it over to a Roth IRA account. Therefore, when I make my Roth conversions, I make sure that I have no other IRA accounts outstanding. So now the money that goes inside of that account, I pay no taxes on, and now the money inside my Roth IRA account grows tax-free. And once I have that account for at least 5 years or longer, and 59 and a half or older, every dime I get in that account, whether it be interest, dividends, capital gains, all that money is accessible tax-free. So I don't care what the tax rate is in the future. I'm living on tax-free retirement. Let's invest.
Okay, let's go.
The goal is to get this to you. I could drive until you get the proper license, and your mom could quit working at the restaurant and help out. You'd be in the black after a year. If we could get another car, this place would practically pay for itself.
Terry, this could be your way out for you and your family. This could be a win-win for us all.
Black folks barely have businesses to pass down to their kids. I know I ain't got nothing for y'all. This would be an opportunity for you to do that for Terry Jr.
It's Jay with Jay Money Secrets. And who am I? I'm a wealth advocate. I'm a stock and options trader. I'm your licensed insurance agent, and I'm an investor. Let's invest. I was talking with a client, and I wanted to share this information with everyone. Companies normally offer group benefit plans, and one of the group benefit plans, one of the benefits that they offer is called insurance. Now, normally they're going to offer accidental and dismemberment insurance and or term insurance. Normally they're going to offer multiples up to 5 times what your salary is. Now, the average American should have at least 10 times their income, their annual income, for the actual death benefit amount for their loved ones. But my company only offers me 5 to 10. Ask yourself another question. How long do you plan on working at your company? Probably not forever. What if you find a better opportunity that's paying more money? What if you decide you want to start a business? Most policies, they actually terminate and they're null and void, which means you have no further benefit from those policies. Then what happens? You still want to make sure that your loved ones is taken care of, because God forbid if a man married to a wife or a wife married to a man, one of the individuals pass. What's the other person going to do without the income that's coming in from that individual? What if you pass and you're the breadwinner? What are your kids going to do? You want to make sure that these individuals are taken care of. And this is why it makes sense to make sure that you're insured not only at your job, but even after your job. Now, once you do leave that job, let's say I've worked at this job and I served it for 5 years, and then I try to go get insurance, which by all means, you should be able to get insurance, but guess what? It's going to be that much more expensive because you're 5 years older than you were 5 years ago. So it makes sense to have enough insurance
and also have insurance at the most cost efficient price possible to always make sure you have insurance outside of your job. And if you have accidental and dismemberment insurance, you literally only get paid out if it's an accident, not if you get a disease and you actually pass, not if you get a terminal illness and you pass, or a chronic illness and you pass. It normally only covers injuries. So the appropriate way is to make sure you have at least the minimum 10 times your annual salary in insurance. And you want to get that now. You can get that outside of your job, and if it's cost efficient, if your cash flow is enough, you can still have insurance at your job. So therefore, if I have it outside of my job, even when I change jobs or I decide to start another business, I am still insured. I still have enough of death benefit that's going to leave behind to my inheritance, where they don't have to struggle and figure out how to solve life problems without my income. A lot of times I see people in the middle class, they start these things called GoFundMes. And a GoFundMe, 9 times out of 10, you might not get the full amount that you really need in order to pay for that loved one's individual. Money left over to take care of their family, at least for the next plus 10 years that's coming about. So do yourself a favor. Don't be unsure, be insured. And what you can do is tap in with me. Let's have that conversation. Let's see what you exactly need to leave behind the legacy that you want to leave behind for ones that you do love. Check the link in my bio. I offer a 30-minute free, let me say that again, free wealth and legacy planning. My goal is to make sure that we continue to build this thing called generational wealth, so we can help eventually narrow and eventually close this thing called the wealth gap. Tap in below. Let's get scheduled to make sure that you're appropriately insured. Until then, let's invest.
It's Jay with Jay Money Secrets. I'm in this beautiful city called Chicago. I actually flew in yesterday, and I was on a plane, and the flight attendant said, "Prepare yourself for turbulence." I sat there helpless, knowing that there was nothing I can do to plan for my next move or a safe landing. But then I started to think, what is it can we plan for? Have you ever planned for your next credit purchase? To get your score up to at least a 750, where you get the best interest rates and also the best terms? Or what about even planning for your retirement? The day that you actually want to quit and walk away from corporate America and start working for yourself. Or you want to leave a job currently that's not fulfilling to you. Have you ever set these plans in motion and then get the results that you desired? Or you're at a point where you don't know where to start at? Connect with me with J Money Secrets. I'll show you how I left a 6-figure job that was actually paying me 6 figures a year, and how I made 6 figures in just 3 months. Connect with me with Jay at J Money Secrets. Check the link in my bio, and I'm sure I have something that's going to help you on your next journey to make sure you adequately prepare for your next steps. It's Jay Joseph with J Money Secrets, your wealth and your insurance expert. Now, I want to take some time to talk about this thing called a dividend. Right? What is a dividend? A dividend is retained earnings, which is excess money that a company has left over after they have paid all their bills and expenses. In this particular scenario, we're looking at dividends or income that comes in minus expenses for the quarter. And there are companies that actually pay out a dividend, so they pay you for having ownership in that stock. And one of the companies that we're looking at is this company actually called Verizon. So now when we take Verizon into consideration, if you look at the top here where it says dividend yield, right, we're looking at a yield of 6.64%. That's what it's paying you to actually hold that stock for the year. That's annual percentage year, APY. What is your bank interest rate savings account paying you right now? What, 0.5%, 1% or less? And then if you look to the left of that, we take into consideration what it is the actual ex-dividend date, right? In order to receive this dividend, you have to be part owner in this company. So you have to at least one share in this company. And if you own that share before what we call the ex-dividend or the effective date, you are entitled to a dividend. Now remember, it's not on, it's before the ex-dividend date. So now if we look in the middle, right above me here, we look at what we call the declaration date. The declaration date is when the company actually got together and decided, hey, we have excess money and we're going to pay out a dividend and what the dividend is going to be. And if you go back to the left here, you see that what the dividends pay out, it pays out in cash per share
is the 66 cents. 0.665 is what you're going to get per every share that you have. This is what we call portfolio, which is a form of residual income. You get paid this whether you get out of bed or not. And the declaration date determines when the record date is. This is when this goes in stone on the company's actual books. Now remember, you have to own the stock in this scenario before April 9th of 2024. I've owned Verizon shares before April 9th, 2024. So now I'm going to get paid out a dividend for all the shares that I have. And when I'm going to be paid out, May the actual 1st. And notice, you see that it paid out February 1st, November the 1st of 2023, August 1st of 2023, May 1st, 2023, February 1st, 2023. You notice something. Yes, it pays out every single quarter, and most companies do. And one thing I like about dividends too is the tax rate. Dividends are normally taxed at 15%. That's lower than the highest federal tax bracket right now, which is about 39.60%. So you should own these companies that actually pay dividends. My recommendation is never own something that doesn't pay you income and or that you cannot leverage. Check out jmoneyseekers.com. I have a stock investing newsletter that I send out every single month to educate you on this thing called stocks. Right? We're going to talk about stock investing and also stock trading. This is going to give you the knowledge and education so you too can also receive this residual / portfolio income as well. Until then, let's invest.
It's Jay Joseph, your financial wealth advisor. 5 things I would do differently in my 20s. Number 1, the primary house that I bought in my 20s, I would have actually kept. Houses appreciate normally over time, and that appreciation builds up equity in that home. Not only that, that's also an asset that I bought that I could be leveraging and creating income from it right now if I ever decided to move or leave from that home. Number 2, start my employer's retirement plan as soon as I start the company or I'm eligible to do so. But with a caveat, I would only contribute up to the amount that my employer is matching and not another dime in addition to that. Number 3, I would not over leverage, whether it be your income, your capital, or your time into any one investment / asset class. If you invest in your time, money, and or credit into one thing, and if that one thing goes bad, it can wipe you out financially, or you cannot recover from it, you're going too hard, you're investing too much. Number 4, have a mentor. It is ideal to have someone that been there, done that, someone that you can glean from, and ask questions to become a better you. What does that do? That saves you time. And what is our most valuable, non-renewable resource? That is our time. And finally, number 5, I would create my own bank. And this is why. It is something that's conservative and it guarantees my money and it compounds over time, and it's what I can use to leverage in the future to buy more assets, with also providing and protecting my income and providing income for my future family if I were to ever pass away. These are the 5 things I would do differently in my 20s, that if you are in your 20s, in your early 20s, or heck, even if you're your 30s or 40s, you can do and implement now. Continue following. Log on, subscribe, comment, like for more information and tips. And this is Jay Joseph, your financial wealth advisor. Let's invest.
When it comes to buying assets, and you should never buy and own an asset that does not pay you and or that you cannot leverage. You should not own an asset or hold an asset that does not pay you and or that you cannot leverage. So let me ask you this question. If you guys receive $10,000 right now, tell me one thing you would have invested in.
A building.
A building. Okay. So you would take that $10,000 and put it directly into the building, right?
Yes, purchasing a building.
Okay. So she just bought an asset, the building. Ideally, we want to make sure that the building pays income. But guess what? Guess how many times she used her money? One time. We want to build wealth. We got to use it more than one time. So what could she have put that money in to access that money and invest it into the building first, and then now her money's working twice? See, stocks, right? So now stock market, someone said they want to talk about the stock market. The stock market is an electronic exchange where people go to buy and sell public companies, right? You can either invest and you can trade. That's two different things. If I trade, I don't own anything. I'm just making income with it. If I invest, I park my hard-earned money and it's going to work for me, whether through dividends and pay me income and or it can appreciate. But guess what? You can also leverage stocks. You can normally leverage about 50% of your stocks. In certain scenarios, you can leverage 70% of your stocks. So I put my money into the stock that has the ability to grow and appreciate, and then I borrow a percentage to then put that down to go buy the building. Guess how many times my money is working for me now? Do you know in our communities, when the dollar hits our community, you know how fast it leaves? Within 24 hours. We didn't even get a chance to invest it, right? So now we've got to identify with all these assets, what assets should I be putting my money into first? What assets can I actually leverage? This is how we build this thing called wealth.
Listen to this, you guys. Life insurance is the world's safest industry. There's an account that yields 5 to 6 times more than long-term CDs, has guaranteed returns in most cases, does not have to be reported to the IRS, can be accessed by any time without penalty, lets you retire 100% income tax-free, and yet almost no one knows how wonderful these plans are because the government places tight restrictions on the advertising of these accounts, even though they are 100% legal. Why are they secret? I'll tell you in a moment. The only way to prove that is to own some. Now, why can't we advertise all the greatness of cash value life insurance? You ready? The government places tight controls and restrictions on the advertising on these accounts because they can't make a dime off of them. If we sold cash value life insurance to everybody in America, there would be no tax revenue for these guys to screw up. When the money goes in, it accumulates without current taxation. When you take it out as a retirement benefit, it is paid out tax-free. And when you die, the death benefit is paid tax-free. Let me ask you something. Don't you think you ought to get out there and tell America this right now?
You sure about that? You sure about that? You sure about that?
Never once in 16 years was I taught about this.
So walk the normal person that's never heard of this before through the whole cycle.
So I'll just give you an example. So if this was the $100 that I just spent an hour working for, this money's got to go somewhere. Most people would put this in a traditional bank. So you put your money there, but then if I take this $100 back out to give to Cody to go buy real estate, does the bank still pay me 1% on that money?
Absolutely
not. If I change one thing and I take this $100, instead of putting it in a bank, I set up one of these banking systems and I put this $100 in. 30 days later, you call me up and say, Chris, I got this great deal. You got to get in on this. I'll pay you 12% if you can lend me $100. And I then go to my bank and I take this $100 and I give it to you. But most people would say, well, it's the same as a bank. Nothing, because I just took the money out.
Yeah.
But you see, that 100 I just took wasn't even my money. So my money's making 6%, but I just took that money out. Whose money do I have? Insurance company. So the insurance company lends me money from their account and collateralizes it with mine. When they do that, that loan they gave me, a lot of people are like, oh, that's bad. I don't want another loan. I don't want to pay it back. Great. You don't have to pay it back because what the insurance company gave you was your death benefit early.
Infinite banking real. So let's talk about what an asset is, right? An asset is literally where I put my time and my resources into something, expecting a greater rate of return. That rate of return will come in every stream of income, whether it be residual, monthly or quarterly. It pays me. Tip, never hold something that doesn't pay you in or that you cannot leverage, right? That's an asset. But an asset can also do what? Appreciate in value. I buy it at 10 and I can sell it for 100. When it comes to buying assets, we always want to buy income producing assets first. Why is that? I got bills every month. I got an SBA loan that I got to pay back. I need income to make those payments. I got a lifestyle that I want to live, right? So imagine if you had $100,000 right now and you bought billions of gold. Guess what just happened? Your net worth just increased. You're more valuable. But how is your mortgage, how is that gold bullion going to pay your mortgage next month? How is it going to pay your rent next month? What if I would have took the $100,000 and bought a laundromat that's paying me net $5,000 cash every single month? Now what do I have? Residual income now. I have more time to invest into myself, more time to go create, more time to learn, right? is Jay Joseph, your wealth and your insurance expert. And I want to talk to you guys about this thing called the stock market. It's a vast asset class that people actually grow their money, create income, another stream of income, supplement their income, and actually build wealth, all in one vehicle, which is the stock market. One particular aspect I want to talk with you guys about is making money when the market actually goes down. Did you know 70+% of the people don't make money when the market goes down? When the market falls, there's 3 ways you can actually make money: by shorting a stock, buying a put, or selling a call. These are 3 ways where you can actually make profit when the stock market falls. Majority of people only seek and can make money when the market goes up. That means they only have a 33% chance of being right. But if you're good enough, you can also still make money as well. I'm going to show you guys this asset, right, by me actually buying a put. I bought a put on this company called Meta, formerly known as Facebook. So as Meta falls, you're going to see that I actually made money. Now, the key thing is the stock market, the S&P 500, normally makes a rate of return of about what, 8 to 10% a year. I actually made about 25% rate of return within 24 hours. And not only didn't do it in one account, I did it in 2 accounts. And guess what? You can do the same thing. For more information about learning, about investing and trading in the market, go to jmoneysecrets.com and click on join our investment link. And that's going to be in the monthly newsletter where I'm going to continue to give you more information about trading and investing in the stock market. Let's invest.
$1 million in, take $1 million out. How much is left in the insurance policy?
0.
No, $1 million.
Then that's
so
the part
let me
I don't
explain
get.
that.
Why would an insurance company borrow my $1 million for 30 days and then let me take it back and still have the policy?
When the insurance company gives you the $1 million, remember they're giving you a loan, but it's a loan you never have to pay back. Because what did the insurance company promise? You know life insurance. What's one of the promises life insurance makes?
If you die, we'll pay.
They're going to pay a death benefit when you die. The insurance companies don't say that you have to wait to die to borrow that money. So the insurance company, when they give you that $1 million back, that loan for the $1 million, it's in advance of your death benefit. Your $1 million never leaves your account, never stops earning the interest. A lot of people don't understand compound interest. So if you put $1 million in and it makes 6%, now next year you're compounding on $1 million plus the 6% interest. And the year after, it's compounding again and again and again. So you're always compounding off a higher balance. But your money's
unless you
out
take
there.
it.
No, it doesn't matter. Remember I said, it doesn't matter if you take the money out.
I saw a for sale sign on one of them. And I got the idea maybe I should get a studio, to shoot music videos for me and a local artist.
Hey, yeah, that sounds like a good plan.
Think so?
Yeah.
Yeah, I just need to, probably do some odd jobs to get enough for the down payment.
Ooh. It's hard out here for an ex-con to get a job, baby.
Tell me about it. But keep working, eventually. What's this?
Your father had a life insurance policy. That's how I was able to keep the house. That's yours.
What?
Yeah. Your father would love the idea of the studio and would want you to be happy. So go ahead, baby. Open that studio.
Are you serious?
Yeah.
Yo! Oh, man. Whew.
Jay with Jay Money Secrets, your wealth and your insurance expert. I want to share something with you guys to let you know why I took out a 20-year term policy out. Number 1, if I were to pass within the next 20 years, my legacy, my son, is going to receive $1.5 million, right? That doesn't take into account any stocks, any bonds, any real estate, any partnerships, any businesses that I currently have. But he's going to receive that $1.5 million. And guess what? That money will be received tax-free. The question is, the value that I'm getting, which is $1.5 million, how much is it costing? Less than $4 a day. Number 2, we have the ability to actually convert this term, which is a temporary insurance policy, into a permanent insurance policy. And guess what? I got 15 years in order to do so. So over the next 20 years of me building wealth, if something happens to me, 1.5 million goes to my legacy. Number 2, within that 15-year time frame of me having this policy, I can convert it into a permanent policy where I can have insurance forever. And not only that, I change it into an asset where I start building this thing called cash value. And number 3, These are what we call accelerated benefit riders, ABRs. These are what we call living benefits. So when I am alive, I actually have different situation scenarios where I get to use the death benefit of my insurance. So when you hear life insurance, the key word is life. Now imagine this. If I get a terminal illness, which it happens, a chronic illness, a critical illness, did you know every 60 seconds someone has a stroke? How many people you know that have a transplant? How many people are disabled or lose a limb or two or three or four, right? When these things happen, even including this thing called Alzheimer's, guess what? I get to access part of that $1.5 million out of my death benefit while I'm still alive if I get a terminal illness, a chronic illness, a critical illness, a critical injury, or Alzheimer's disease. Imagine that life insurance that you get to use while you're alive. But the key is me being able to access part of that death benefit while I'm alive prevents me from having to sell my house to get equity to pay for my living expenses, my medical costs, prevents me from having to sell money in the market out of my retirement plans, and I may be penalized indirect tax, prevents me from withdrawing or dwindling down my savings accounts, right? It helps protect the wealth I've already started building, and I shift that risk to an insurance company. So let me ask you, if something happens to you, what do you have access to? Do you only have a death benefit, or do you have these things called living benefits and the option to also make your permanent policy? If not, you need to get with the right agent. I'm that guy. Take the link in the bio. Let's schedule some time to talk about what you have to make sure what you have is enough, to make sure that you got options, not only options upon your death, but even while you're still alive. Let's invest.
A lot of us, we talk about leaving a legacy. A lot of us, we have this thing called the business, and or we have a job. What does that do? Produces money. The money is called what? Income. Now, we understand how to go get this money. We understand how to get this income, but the question is, what do we do with it? We use income, we turn it into capital to invest, and what's the goal that we're trying to accomplish? Somebody said it. Wealth. All right? So let's define what wealth is. Wealth is an accumulation of assets that buys back my time, that affords me to live the lifestyle that I desire.
Or a scam. Infinite banking is real. It's this idea of I'm going to open up a life insurance policy, not for the death benefit, but for the living benefits. Most people, the way they do life insurance is they'll say, oh, in the event that I die early, I want to have some term. So I'm going to pay like $30 a month and get $500,000 or $250,000 of term. It's cheap. And after 20 years, it dries up, it's done, and it's gone. So then people are like, well, what about whole life insurance? Whole life or universal is where you basically say, I'm investing in death. People are going to die. And when people die, there's going to be a cash out of policies. And so these life insurance companies are really banks. They have the ability to predictably produce dividends of 5, 6, 7% every single year. Because of that, people will say, well, instead of just doing $30 or $100 a term, I'm going to put in $800 or $8,000 a month into a whole life policy because I want to earn 5 or 6%. And they're trained to be okay with that because they're thinking, well, my 401k pays me 5% of my 30-year average. My IRA pays me 7% of my 30-year average. So in their mind, they're like, this is just another way of getting some diversification.
No. You're supposed to use life insurance while you're alive.
It's called life insurance, not death insurance. Let me show you why. So imagine your life insurance policy is a house. You see, every time you make a payment on your house, you build equity in the house. You can then use that equity for whatever you want by getting a home equity line of credit. See, but life insurance is way better. Check this out. With life insurance, when you put money in, you build equity in the form of cash value. That cash value is guaranteed to grow 100% tax-free. The money's protected against judgment and lawsuit in most states. You can access the cash value at any time for whatever you want by taking a policy loan. But unlike your house, there is no credit checks required. There's no financial statements required. Unlike your house, there's no repayment terms required. You can take the money and buy a car, go on a vacation, or do an investment to make more money. And the whole time you're doing this, you're not interrupting your guaranteed compound growth.
That money that comes in allows me to do what? Pay my debt service, any debts I may have outstanding. Property debt I use to leverage the body asset. Number 2, it pays for my lifestyle. Number 3, it gives me additional money to leverage from other institutions saying, hey, I got this cash flow coming in, give me more access to more money to do what? Buy more assets. But the number one asset that we need, what is the number one thing you need when you're starting off building wealth and when even we already have wealth? What does everybody have in here? Money. Not money, go ahead. I give you guys 2 more guesses. Somebody said insurance? No.
Self.
Yourself is an asset. I love that answer. I love the way you think, right? So we're born with ourselves, but what do we all have though? Time. Number one thing I'll help you guys out is a bank account. It's a bank account. Does everybody have a bank account in here? Yes, I know what I'm talking about. But let's talk about it. Yet again, why are we building wealth? Why are you building wealth?
For my grandson, my daughter, for the future.
For children's children. You said yourself is an asset, right? If you were to pass, that's an asset that's no longer there to build wealth for what? Your children, your children's children. How do we secure that? Right? We talked about we put our money inside the bank account. Whatever we have saved, and keep in mind, wealthy people don't save their way to wealth. You leverage your way to wealth. So whatever you have inside of that bank account, guess what? That's what they get. What if they have money in this bank, they can get 10, 20, 30 times more if the asset were to die. So now my inheritance, they get more. I define wealth, right? Well, when we look at wealth, it's an abundance of something. When we talk about it from a financial literacy standpoint, wealth is an accumulation of assets. But what is an asset? An asset is something, Walmart can be an asset. It depends if I'm buying or if I'm investing there. But an asset puts money into my pocket, whether it be residually or it appreciates, So an accumulation of assets that does what? Allow me to buy back my time. And it also provides me money to what? Live life on my own terms. What's going on, everyone? I hope all is well. This is what work location independence look like. I can work from anywhere and make money. I'm Jay with Jay Money Secrets, and I'm showing people 1, how to create money, 2, how to grow it, number 3, how to protect and preserve it. How am I doing that? I'm showing people how to turn credit to cash. Once you have that cash, I'm gonna show you how to grow it. Use it as capital what? To build wealth. And then I'm gonna show you how to protect and preserve that wealth. Keep following, more juice to come. I look forward to showing you how to achieve the wealth of the 1%. Stay tuned.
I know your worth, young.
What's going on, everyone? It's your boy Jay with Jay Money Secrets. Appreciate you guys tuning in. Guess where I'm at today? Guess what I'm about to do? I'm about to buy a car. A car is normally known as what we call a liability. What's a liability? Something that's going to take money out of your pocket. But guess what I'm going to do? I'm going to show you guys how to turn this car and make it an asset. And what is an asset? Something that put money into your pocket. Now let's see which one, or which 3, or which 4 I may get. Stay tuned.
Call me Sniper Gang. We got stupid sticks. FedEx employees. Bitch, we shipping bricks.
When I know I had all the millions and I didn't even have a credit card, the dumbest. I was like the dumbest person ever. I used to just spend money on everything. Man, please. Yeah. Please. I'm going to open up an insurance, put $2-3 million in my insurance, and borrow from that and put it back in. I never lose my money, ever. And anybody get money, I'm giving you a promissory note. Because you gonna promise to pay this back. I'm gonna bring you to court.
I'm ready for the Walker Financial.
I'm saying you should do the live seminars.
Got a full-time job, but a nigga still can't afford.